With that, let me welcome everybody. Thank you all for attending this morning, one in a continuing series of Ben webinars. Why are we doing this? A couple reasons. We are looking to try to build sessions around certain topics that we think are valuable, not only to our portfolio companies, but to the entrepreneurial ecosystem at large. So in this sort of continuing series of webinars, we're hoping to find topics and speakers who will provide learning to our entrepreneurs in our region, but also this is a connecting function. So by getting some of our speakers in front of you, you can associate a face with a name and then their acumen, and so the ability then to connect with them offline will give you a chance to more easily network and then take advantage of services or expertise or other things they offer. So it's an educational side and it's also a connecting side. So that's really the goal today. The topic today is on this really lovely spring day, and I have to say, coming in to the office here, I'm really there's a sense of kind of rebirth and renewal this spring. So I'm hopeful that we have all have brighter days ahead. So with that in mind, I want to turn over the webinar to Steve with a couple of provisos. I saw that almost everybody has their microphones muted. I'll go on mute after I stop talking here. And then for questions, we do have a lot of people attending today. So my recommendation is just put in some questions in the chat room, and Nicole, Kate, and I can help monitor that. And if we can, we'll hang in there as long as Steve can, as long as you can, at the end of the webinar to answer questions. And Steve, I'll just ask you, we usually put out a notice getting feedback on the webinar. If you want us to include, the possibility of people wanting to have an office hour with you or reaching you directly, we can put that in our feedback form, and therefore folks can find an easier way to get to you after the session, because we know it's going to be a crowded time today and could be a lot of questions on the docket. So with that, let me do a quick introduction. Great topic today. Entrepreneurs are so busy and they are so consumed with all the things on their plate that sometimes the hardest thing for them is to think about exit when they're trying, as best as they can, to make all the things that make a business work happen. So exit seems like it's remote and far away. But what really is true is if you don't start putting some pieces in place early, it's gonna come up and bite you later on. And Steve is going to talk today about what you really should be thinking of, even though you think that future is just out of reach at this particular moment in your business's life cycle. Steve, thanks, Steve. Steve served on my investment advisory committee at Ben Franklin. He is now at G Squared Partners. Has a long history in finance and investment banking. Steve, I'll let you, finish out the introduction and start and drive the presentation at your own pace. So thanks again for everybody joining. The last point is this is being recorded. All of our webinars are archived. If you want to go back and see some of the other topics, please reach out to Nicole, myself, or Kate, and we can get you links to all the archive webinars, and eventually we hope to have on our website, a place where all of our webinars are ultimately searchable and you can see any of them either again or for the first time. So Steve, let me pass the baton to you and take it from here.
Okay, thanks, Mark. Thanks, everyone. I'm going to share my screen now.
Yep.
Everybody got it? So that's our agenda. Good morning, everyone. I'm Steve Economou. I'm a managing director with G Squared Partners, which is an outsourced CFO and accounting practice. Most of our clients are technology companies in the Northeast corridor. I'm at G Squared to work on help clients with transaction advisory and sale readiness. So my job G Squared is a little bit different than everybody else's. There are a lot of people on the call today, so I'm happy to answer questions as we go, but it's probably best to put them into the chat. And in my view, I can't see the chat because I'm doing a screen share. So Mark or somebody, if they're in line with the topic that's on the screen, please go ahead and let me know. Also, my contact information and a link to schedule a meeting with me will be on the last slide. So I am happy to do that as we later on for people who have follow-up questions. But I'm available after 9:30 as well. So here's our agenda today. I'm going to talk a little, just to calibrate, talk a little bit about the process and the difference between attractiveness and readiness, and just try to get everybody to understand the ecosystem around a transaction. I want to be careful. Being an entrepreneur is very hard, so I don't want anybody to come away with this with the idea that I'm suggesting that you overspend on professional fees and administration at startup, but I'm trying to give you a perspective, and with the goal being to retain and enhance your own value as a shareholder, because so many buyers out there create value for the buyer by doing very little and well-known things immediately after sale, and that's in many instances easily captured by the existing shareholders instead of giving it to somebody else. This and the presentations would be more focused on a sale transaction, because that's really the bulk of transactions. I'm not going to talk about SPACs or IPOs or ESOPs. Those are all very technical as well. But in the grand scheme of things, M&A is a much bigger part of exit strategy. So again, this is just to calibrate. If I give you one piece of really good advice, and get a good lawyer at the outset. A good corporate and securities attorney is well worth the cost. They're going to prevent lots of problems and help you along the way. And to some degree, in many instances, they are the quarterback for a transaction in the whole process. Many of the pitfalls that companies encounter turn out to be legal or tax issues. Like, accounting is part of it, but a good attorney will know that, understand that. Keep in mind, a lawyer will probably work on a dozen or more transactions a year, so they have a perspective that's really, really helpful. The sale process, this is for illustration purposes. This is something an investment banker will put in their book, but it is an extraordinarily intense 6 to 9 month process of preparation, presentation, investigation, also known as due diligence, and negotiation. It is always longer, harder, more intense than nearly any entrepreneur expects. But it's hard to win a sale pitch or a mandate to represent somebody if you go in and tell them hey, this is going to be really hard and expensive, and you're not going to enjoy it. But that's the reality. But there are ways to make it easier and quicker, and being prepared is one of the ways. The expertise of people who work on M&A on both the buy side and sell side is highly specialized. It's not something that most entrepreneurs have experience with. It's not something they do in the day-to-day, and it's frequently outside of their comfort zone because M&A in the process is more often than not coloring inside the lines. It's not being creative. It's not making law. For the most part, we have to make sure the accounting is according to GAAP. We have to make sure we don't create a tax problem. We want to make sure the insurances are adequate, et cetera, et cetera. So this is a sample timeline. It can be done much more quickly. Nowadays, you hear about closings within 90 days, if not 60 days. But frequently it can take much longer for a company that has issues. But as the headline says at the bottom, if you're prepared, you'll be well ahead of most sellers, and you will have a more efficient process, and you're going to reduce the closing risk. Closing risk is a huge issue, which is why you're going to spend all this time and money if your probability to get to closing is always something less than 100%. But you want to have it closer to 100 than 0%, and the preparation is a key part of that. We're here to talk about readiness. Attractiveness is a little bit different. That's size and growth, location in some cases. They're clearly hot industries now. Industrial technology, absolute size is attractive. Whether a company is capital efficient or not is attractive. Capital efficient companies are more attractive than companies that use a lot of capital. And the availability and cost of capital also talks about overall market attractiveness. So the point I want to make here is that it would be a real shame for a company that is attractive outwardly. It's capital efficient, it's growing great. It's got a nice absolute market. It doesn't use a lot of capital, but it's just full of accounting errors, unsigned contracts, et cetera. So you want to be both attractive and ready at the same time, as much as possible. A little bit more on readiness. There's owner and shareholder readiness, and frequently there are partners. If anybody's venture backed or has attracted institutional capital, in most cases, the investor has an expectation of selling within a time frame, depending on what they've told their investors. For the single owner entrepreneur, it's much more psychological. Am I mentally ready to sell my baby? What am I going to do next? We've certainly had owners afraid to sell their business because they believe they'll die within a year after selling their business. Will I make enough money to meet my financial goals? For anybody that's venture backed, keep very close tabs on your waterfall and what valuation you need to get to the outcome, the successful outcome that you expect. Certainly our clients are very cognizant of dilution and valuation. So keep that in mind. It is not uncommon for venture investors to carve out sale proceeds for founders to make sure that they're still motivated to keep moving the company forward towards an exit. Company readiness and along with financial performance, I want to highlight expected financial performance as well. A good example nowadays is many companies have gotten a lift from COVID, especially remote technology companies, and those have been particularly hard to value going forward because of questioning the sustainability of last year's growth rate and profits. I've also seen things like office product companies pivot to sell sanitizers, and they make more money selling sanitizers than they did selling papers and pads and office furniture. So the question for the future is, what is that recent growth pattern normal and sustainable? Timing and luck is also important. So if you're prepared and you have a pretty good understanding of what companies are valued in your industry and how deals get done, maybe you're lucky and somebody approaches you with a over market value at the right time. So again, if you're ready, you'll be able to take advantage of that opportunity. Understand your valuation, at least what you think your valuation is, and what drives that valuation. In many technology companies, it's growth, monthly recurring revenues or annual recurring revenues, growth, capital efficiency, and gross profitability, gross margin. Another thing that's somewhat by middle market sellers, they forget to think about depth and breadth of management team. And does the owner plan to stay or just leave immediately? So stay for long term, stay for a short transition period, or just try to leave after closing. Typically, it's hard to leave immediately after closing because the owner knows so much. So those are other things to think about in terms of readiness. The point I want to make here is to get back to the complexity of a transaction. Here are the teams. The seller's team, and yes, the point is to be a little bit overwhelming. The seller's team is the management and the board, the investment banker, a lawyer, an accountant, a tax advisor, probably your insurance broker and your wealth planner who's telling you whether you can live after you have enough money after closing to meet your family's goals. Then there's the buyer's team, which is everybody that the seller has in more. Hordes of industry, they'll have an IT consultant, marketing consultants, private investigators, hordes of analysts. So the point I'm trying to stress here is, expect and prepare that you're going to face off against a professional buyer with a big team. You're not going to face off against the it's a nice notion, but it's extraordinarily infrequent. A couple of CEOs get in a room, scratch something out on a napkin and shake hands, and then 10 days later you have a 10-page agreement and you're done. That's not the bulk of what how the world works. The bulk, most deals are 100-page agreements, take a couple months to negotiate, lots of people, lots of distraction to the entrepreneur, hugely distracting to the entrepreneur and the management team. And that's why it's better to be prepared and have a good team of advisors so that you, the entrepreneur, and the management team can continue running the successful business, because it's happened on many occasions that the owner takes his or her eye off the ball, and company performance suffers in the midst of a transaction negotiation, which is the opposite of what you're trying to do. Additionally, it is not the time to be finding out bad things about the company or an individual. And we've had people, arrest records, credit scores, everything comes out in the due diligence process. And it can be, in most cases, it can be managed. But what you don't want to do is surprise a buyer or investor with these kinds of things. Any questions yet, Mark?
So far, we're good.
Oh, wow, perfect. So now we're going to get into the nitty gritty. So as an investment banker, you get on the phone to try to sell a company. I'll give you a little bit of perspective. We get engaged. We tell the client frequently, give us a month to get ready to go to market. Let's say we're starting from standing start. Give us a month. We collect a lot of financial data. We put it into a book or a confidential information memorandum. We develop a long list of potential buyers and investors. And at the end of that preparation, the investment banker's preparation phase, which was the first part of that timeline, we have prepared several documents: an NDA from your lawyer, a blind executive summary, confidential information memorandum, and we've populated a data room, and we have a good financial model. So we have 1 month to do all of that. Frequently, what happens if the basics aren't done, then that first month can stretch into 3 months, 6 months, sometimes longer. So the first questions that I typically get asked when I talk to a live buyer are, this is just an anecdote to keep in your mind: why is the company selling? How do they make money? And how will I make money if I own this thing? Those are their first questions. And so the basics are all going to go into try to answering those questions. Keep reliable, timely, and consistent financial statements and tax returns. That has such great value in signaling your seriousness of actually selling the business, as opposed to just doing a price check. Couple of examples are that things like you get a financial statement that has accounts receivable, and you also get an age accounts receivable statement, and those numbers are different, and nobody knows why. They're might not be too far off, but they're not the same number, and they should be. Another problem is financial statements come out. They're issued by the company erratically. Instead of being issued on the 5th day of every month, they could come out on the 5th or into the next month, depending on a whole host of internal issues of the company. When you're selling, the buyers want to know that on the 10th of every month, I can expect the financial statements from that company that I'm pursuing rapidly. I'm trying to get to closing very fast. It's predictable, and I understand what's going on with the numbers, and I don't have to get a long explanation about why something doesn't tie out each month. When the numbers come out less predictably or slower after pattern than the history, buyers immediately get suspicious that something's going wrong, and they're trying to figure it out or make adjustments to smooth the problem. So that's just reliable and timely financial statements. Your books and records and contracts are in order. Simple things like board meetings, stock certificates, contracts are signed, that you have a signed copy. Extensions have been extended. I don't think I've ever worked on a transaction where all these things are done. Having a good set of KPIs. Frequently in management meetings, a question will come up like, what are the 3 things that you look at to run your business? And you don't want the answer to be necessarily monthly profits. It could be backlog. It could be number of orders. It could be plant deliveries each day. But something that is predictive to the owner or the CEO that they look at each day or week to tell them how they're doing. Again, keeping in mind that the buyer, if you use the car metaphor, the buyer just wants the keys and they want the car to run the same way as the day before they took ownership of that asset. And then if you have KPIs that run your business, have the data that supports that, and you can discuss the trends in the data, et cetera. Review insurance policies. Again, many entrepreneurial businesses are underinsured from the perspective of the buyer. That gets you into issues of whether you're going to be able to sell stock or assets, or whether your warranty provisions are adequate, whether your insurance is adequate, depending on your line of business. I'm not suggesting that you buy too much insurance, because that's expensive, but are you covered enough for employee relations and umbrella coverage and D&O insurance and everything? That's, again, your lawyer would be a good resource there. Know your addressable market, or at least be confident that you know your addressable market. Some people answer this very well, which is, well, it's everybody has a pharmaceutical plant that does this kind of work, and we talk to these scientists in each of these plants. Other people just say, it's anybody that could buy a military part. I don't know. So that's the owners and the CEOs that can really talk about the market well, really set themselves apart. Keeping in mind, one of the things I'm talking about here is The goal is to get you as much money as possible for the company, not just to be able to sell it. We're talking about selling for a premium, trying to capture a premium valuation instead of just selling it for 4 times or 5 times. Let's sell it for 8, 10, or 12 times instead of those pedestrian numbers that anybody can get. Lots of companies can get sold, but not every company can get sold for a premium value. So that's the real goal here. It's not just to sell your company, but to sell it for a premium. Why do customers buy from you? This is like the elevator pitch in raising money, but it's not because you're cheapest, but you solve a problem. And what's that problem? Why is it, and why do they need to stay with you? And who else is trying to solve the problem similarly or not? It is helpful when you go to market and you talk to strategic buyers is to understand your customer base relative to their customer base and why it might be attractive or really or potentially unattractive to them. If they're serving the same customers and you're head-on competitors, many entrepreneurs that I know are reluctant to have conversations with direct competitors, I think for obvious reasons. Deal with skeletons in your closet. It's not uncommon for people to have skeletons in your closet, like having suspended driver's licenses for DUI, for these are just things that I've experienced in my career. Somebody with a gun charge, somebody with DUI, somebody with bank fraud earlier in their life. I mean, not that those are great, but they're lessons learned, and it's better to. One had a labor dispute. They had a class action lawsuit. Get those out on the table. How they were resolved. Get them behind you. It's not good to have them discovered later on. Because if they're discovered, it's as if you're hiding from something. And that doesn't build confidence in the buyer that you're dealing with them in good faith. Resolve and minimize internal disputes, especially among management teams. It's common practice to have management presentations for the finalists in, let's say, an auction setting. So the process is we receive expressions of interest. Those with the better expressions of interest get invited. Let's say there's 20. Those are whittled down to the top 3 to 6. Those 3 to 6 companies come meet with. This is just sample. It's not how those 3 to 6 come and meet with the management team, and not just one person. I have had management presentations go very badly. One in particular, there was the sales VP in a management presentation proceeded to talk about everything the CEO was doing wrong during the management presentation. He had some axe to grind. I don't know what he was thinking, but he did not show up at a management presentation again. Internal disputes are common. I'm not even suggest that you resolve them, but get everybody on the same page going forward through this process. There's lots of ways to do that, whether it's through incentives or transaction bonuses, threats, but make sure that everybody looks and acts aligned. Have realistic expectations, not just in terms of valuation, but in terms of how long it's going to take, The terms of an agreement. The agreements are complicated documents. There are hundreds of pages. They have things like reps and warranties and indemnification provisions. And I've certainly had clients who've said, I don't want to provide any indemnity. I want to be able to walk away after closing. That's not realistic. And then communicate wisely. You don't need to share all your dirty laundry, but it's a balancing act of being open but not being negative. And one of the investment banking techniques is to try to reserve good news for later on in the process, because it's not uncommon that you get bad news as you go through this investigation. So you like to save some good news, like a big new order or a new contract, or big recurring, or somebody's re-upped for more. It's good to save good news too, because bad news will come too. It's just part of running a business. And bad news, in most cases, it's just tell them immediately with, here's what happened, here's why it happened, here's what we're doing about it. But don't surprise them with it, and don't surprise your advisors with it too. I've had clients call buyers directly, tell them the bad news without even me knowing about it. And then I get the phone call like, "What? Why didn't you tell me this was happening?" Or the lawyer tells me it's not good for anyone. So try to stay aligned with your team. So this is the next level of due diligence, and this is where I'm going to call this the wish list. This is going to be where much of the due diligence focuses. There's going to be a lot of focus on customers, customer retention, and concentration. Customer concentration is a very early question in every transaction. Where do they get their revenues? Do they have more than 10% of their revenue with any one company? Do they have more than 20%? In smaller companies, it's not uncommon to have 50% of revenues with 3 or 4 major customers. Additionally, there will be analysis on customer churn. How long did they stay? Profits by customer. Our profits is EBITDA is 50% of the EBITDA margin associated with just one customer, and the other 50% is with 50. We'll see those kinds of issues pop up. Was it one big contract that created the growth? Where is the growth coming from? Is it from one customer? Is it from 2 customers? Or is it evenly split? So growth, so not just where last year's revenues were, but how have customers performed over time? Have customers been churning, or have we continue to accumulate logos? Where are the profits? Are those concentrated? Where are the growth rates? Are those concentrated in 1 or 2 customers or contracts? And then what's the potential with each of those? How does that relate to the reasonableness of the revenue forecast? Revenues are, as an old mentor of mine used to say, revenues are later and maybe, and expenses are now and for sure. So it's going to be a lot of issues. There's going to be a lot of due diligence on customers. You know, and for technology companies, it's equally important on sometimes technology companies, they're one of the questions is it really a company and a piece of, is it really a software company, or isn't it just an app that belongs with a bigger company? Suppliers and supply chain risk. Let me go back to customer for a second. And then who are the customers' customers? In this age of the pandemic has put supply chain and in a higher level of scrutiny, and same thing with customers. If I was a really good customer, but I sold to restaurants, that put my revenues at risk. So those things are, and in the supply chain, where was I getting semiconductors, or was I getting products out of China, and did all my products get backed up in the Suez Canal? So customers and suppliers the due diligence is getting 2 and 3 levels deep now. It just wasn't before. Supply chain risk. Again, if you have one key component that's coming from one customer, or 2 key components, or 1 key component, and you can get it from multiple suppliers, but they're getting it from one or 2 sources, that's a risk to the buyer. And if something bad happens in the supply chain, can they mitigate it, or how can they get around it? Similar analysis for products and services. What drives growth, profits? Are the products and services, are they technological dead ends, or do they have a bright future? Who buys them and why? Again, this is a matrix of things, but in any quality of earnings report that's done by a buyer, there's going to be a deep dive into any of these items here. The quality of inventory, turnover, and I've never had, I think every company that has inventory, even if it's work in progress or a service business that has contracts in process, I would say 3/4 of the time there's an issue with inventory accounting and inventory quality. There's usually something obsolete. Either there's something obsolete, or they've written off inventory faster than tax laws would suggest they should. Is the inventory turning faster or slower? What have been the trends over time? Has the company had to invest more or less in inventory? Is it investing less in inventory for a good reason, or is it just because they're trying to dress up the balance sheet for a sale? What are the inventory policies, and have they followed them for inventory accounting? Or do they just change them every month or every year? Accounts receivable, again, that goes into there's a number of issues there. Clean cutoffs, quality of the customers, quality of the customer relationships. Are there issues with, so you can't just look at a gross aging report. If one big client has a big receivable over 90 days, why is that? Is it credit issues on the part of the customer, or is it service issues on the part of our client that's trying to sell? Long-term trend analysis. Prior to the pandemic, it's not uncommon, especially with companies in cyclical businesses, oil and gas service being an easy example. How did they cycle? What did they do in 08 and 09? How does a company look over a 10-year horizon? If I have a view that the economy may have some weakness in a couple of years, what's this asset going to look like if it has a down cycle then? And how did it? And my best analog for that is to look back at the last down cycle and see how they performed then. I know that's not relevant for many early stage technology companies that have been in business for 2 or 3 years, but I just wanted to mention that. But it is good to keep a very as long a look as possible to your business as you can. Well, why did your revenues go from 5 million? Why did your growth taper and then restart, or taper and go down, and now you're projecting, well, we've changed our product mix, or we started by doing a lot of service and now we're concentrating on product sales. Those are all good reasons, but having a long-term trend analysis is important, and important for you to be able to explain it. For people who have hard assets, equipment, capital expenditures, and asset turnover, when traditional buyers buy a company, they look at free cash flow, and they separate capital expenditures into 2 categories. Typically, one is known as maintenance CapEx, and that's just an ordinary cash expenditure during the course of the year. And another one would be project CapEx, or special projects, and those will be considered non-recurring, like the purchase of a building, or a big piece, one unusual big piece of equipment, or a computer upgrade. All of those are different than maintenance CapEx.
Steve?
Yes.
Just a couple of quick questions here. When you talk about long-term, how do you define long-term in number of years? I know there's some flexibility, but in today's world, what is considered long-term?
Looking back or looking forward?
Good, either way. Great question. Either way.
So looking back, I would just go back as long as as much as is there, to about 10 years, or to the point that the business is if the business has changed in the last 5 years, it's had some fundamental change, I'd go back to when it fundamentally changed and go forward from there. So some look back that makes sense for the business. If it's always been a widget distributor, it's been doing the same thing for 20 years, I'd go back 10, or to the last down cycle. Look, it's not uncommon for investment bankers to take the reason for that question is investment bankers will take, well, what was the last year? Let's go back to the years, and so they didn't have, so we don't show any dips, and they've only grown since our last year. So we'll take it back 3, 4, 5, whatever year gives us a nice growth pattern. So that's why they ask for a longer term. But you can't make that judgment without looking back. So that's how going forward, it depends on the business, but I would say that typically a 3-year look forward is minimum for some kind of financial projection, and then it's really up to your level of comfort. Sometimes technology companies have to show a longer forecast, as hard as that is to do, because that's just really when they're going to take off. But I would say 3 to 5 years. I wouldn't put together a 10-year forecast. I mean, people do that for valuation purposes, but I wouldn't do that in terms of selling a company. it just begs it just kind of invites a long earn out, and nobody wants that.
Just another question, with a lot of companies, technology becomes a greater component to their business model, if you will. So what kind of IT readiness in terms of due diligence does the selling company need to demonstrate? So is there a bar, and what is that bar on, are you doing things from an IT perspective where you are ready to be acquired? And what are the things that could happen that can show you're inferior or superior on the IT readiness?
From your internal systems, right, point of view.
Yes.
Not from your product IT, but
from your internal systems.
I think it's just the ability to tell a horror story. One time I had a client that we're kind of muddling along with QuickBooks, but we got the financials out on time, and it wasn't perfect, but it got done, and it was relatively reliable. They then switched because they needed more data and they wanted more. Then they switched to SAP, which turned into, I shouldn't have said the name, but they switched to a really large accounting and ERP system that turned into an unmitigated disaster. That wasn't good. So it's not necessarily true that you have to buy the most sophisticated ERP system. I have seen companies succeed very well with just knowing their CRM, and it's not doing all the bells and whistles. It's just knowing their pipeline cold and having some data with that. So I would answer that with, make sure that what you have is reliable and consistent, and that well. Plenty of companies can run pretty well on QuickBooks. You don't have to have the most sophisticated one, but what you have has to work and be predictable and reliable. I'm not an IT expert, but I've seen too many problems I've seen as many companies stumble trying to get to a more sophisticated IT system because internally they didn't have the manpower to manage it, and they got oversold on a product and just couldn't manage the project. So I'm very wary about promising too much on IT. I've just seen too many problems with it. But if you can get your financial statements done on time, you can talk about your pipeline reliably, and you can describe your customer base. To me, that's a win.
Okay, sorry, just a few questions kind of poured in here at the end, and I know we're interrupting, and just maybe we'll fold these in, and then you can finish your slides. But some of the questions that came in, one was around cost. I mean, how much is all this cost? This whole process, it's a very complicated process. What are the expenses, and what's that bill going to look like for companies, probably typically startups or younger companies? Second question is, at what point does an owner really think about selling? So what triggers that selling decision, and at what point, and is there a commonality around, at what point should someone start thinking about selling? And then, I think let me just ask those questions. We'll let you go back to your presentation, and then at the end, if people want to hang in, we'll address the other questions. I'll just throw those two out that came in the chat.
So a friend of mine had this great quote about the selling process and trying to get a client ready. He called it deferred admin expenses. It's less expensive in hard dollars to go to spend as you go than to try to catch up, but it may be more affordable. Look, accounting, I mean, just to blow our horn, we are less expensive than probably creating an accounting department. But our philosophy is it's better to have sales and a good product and start generating profits than to have really good books. So I would interview attorneys first. They're typically are flexible working with entrepreneurial companies in terms of, and Mark knows them, there are several good emerging growth attorneys at reasonably priced firms in Philadelphia. They're a great resource, and there are people that specialize in software and life sciences, and there's plenty of good attorneys. In terms of accounting, I don't know that an audit is needed. What's needed is reliable books and records. I will tell you that transaction fees depend on the size, but attorneys could be, just the closing cost for an attorney could be anywhere between $100,000 to several $100,000, depending on the complexity. And what you don't want to do is have a small transaction with a big attorney fee. That's what I'm trying to mitigate. Let's see, if you sell your business for $5 million, and the attorney should have cost, if you were a well-run, well-documented company, it should have cost $100,000 or $150,000. But because you were a mess, the attorney's fees turned out to be $300,000 or $400,000. That's the cost benefit trade-off. If your valuation's $50 million and it costs you $300,000 or $400,000 to clean up your mess, then you probably don't care. So it's all relative to the value. Where on the accounting side, that's where that's most expensive, or where it can be expensive, is in cleaning up taxation problems. Like if you're there are less S corporations, but if you're a defective sub S, or if you have a SALT tax issue and an attorney finds it and you have to go around to a bunch of states and try to catch up on sales tax, or if you have a city of Philadelphia business income and revenue tax that you didn't book properly or pay properly. Those are the things that turn out to be expensive and cost time, money, and terms. It's not a great answer, but it's the best one I can come up with. In terms of when to sell, in many cases, it's from the owner's point of view, it's something happening in the ownership base, like they're aging out, or their investors have decided to sell. The company's not doing well, and the bank said, "Let's go." There's some kind of impetus to sell from within inside the shareholder base. The other time to sell is, hey, look, I've been running a great business. The market conditions are great. I'm still in a place where I can get maximum value and be here for 2 or 3 years and get an orderly transition out and protect my employees. Those are ways to think about it. The one that you don't want is, well, the bank's mad at me and I need to get them paid before they exercise my personal guarantee. But it is, so in our clients, it's frequently as a result of something going on in the shareholder, including death. I've sold companies because one of the shareholders, in a couple of times in my career, I've sold companies because one of the shareholders died, and the widow didn't want to own the other half of the assets, the rest of the company. It's also not the best leverage when you're dealing with buyers.
Thank you. Listen, just as a time check, we blocked off 8:30 to 9:30. We just reached the 9:30 hour. What I'd like to do is, as is our standard protocol, Steve, maybe let me turn it back to you. And for those that can hang in, if you want to finish your presentation, and we do have some unanswered questions, but I'd like to have you get through your part of it. And if those that can hang in will do so, you'll be able to, we'll take you to the end. And maybe depending, how we sort out, I'll compilate the questions, and we'll go back to Steve and have some of those answered. If there's not enough time to do this morning, we can do follow-up answers to some of those questions. So Steve, just for completeness, why don't you run through it, and those that can hang in, please do.
Yeah, I'll run very quickly through these. So the next one was asset turnover. Look, there are plenty of ratios to look at fixed assets, and that can judge whether somebody has been either, or make a judgment as to whether a company has been overspending or overinvesting or underinvesting on capital expenditures. Like we like to say, oh, they've overinvested. When you get this, you don't need to put a whole lot of money into CapEx. That also gets into a taxation issue about recapture provisions, et cetera. Another very technical thing that a tax advisor would have to go over. Add backs, non-recurring charges, and normalization adjustments. Like, so add backs are things like personal expenses. Non-recurring charges would be like a litigation expense. It's not, that was one time. Normalization adjustments are for things like, let's just say a pandemic, where we say, well, that wasn't normal. We're going to try to get it back to what normal would be. Everybody, most companies calibrate on full-time equivalent metrics of some kind, revenues per FTE or EBITDA per FTE, the kind of industry investors. This professional universe of buyers will have metrics around revenues per FTE and earnings per FTE, and they'll decide very quickly how you compare to a peer group. NOPAT is net operating profit after tax, working capital, and these are all things that go to a free cash flow calculation, and net working capital, which is always a big discussion in a purchase and sale agreement. What is a normal level of working capital for a company to have at closing? Know how your working capital cycles. We calculate something called cash conversion cycle, which is to know how long it takes, which is a metric that says from the time I buy inventory until the time I turn it into cash in my bank account, what are the net days? All really good metrics to follow. So with that, I'm going to end the slideshow and stop sharing, and I'll try to answer questions.
Mark, you're muted.
I'm sorry about that. So thanks, everybody. A lot of questions. Let me go from most recent backwards in time. Russ had a really interesting question, and it's sort of around the auction process. So his question is, if you started this process with a potential acquirer, is there any way you can leverage that process that you have with one potential buyer to other potential buyers? And how do you do that when you have one fish that's poking around the hook with the worm on it? Is there ways does that process lead to others that might be able to be induced to look at your company?
If I told you that, you wouldn't have to hire me. So the short answer is yes. It takes a little bit of finesse. The one way to do it is to just a play for time and say, hey, I really appreciate the outreach. We're not quite ready. We're not ready to entertain full discussions with you, but let's give us a chance to get prepared and use that to play for time, and then maybe approach the other potential buyers. The then you can have somebody contact them, like your lawyer, your accountant, a financial advisor. If you want to show seriousness of purpose, I certainly, as a service provider, we'd like to get involved. But if you'd like to show seriousness of purpose, engage somebody to talk with the buyer, the prospective buyer, and multiple buyers. So it can be leveraged. But once you sign a letter of intent, every one of which has an exclusivity provision, which means you can't talk to anybody else, you will lose your leverage.
So so as a follow-up, do you recommend, and can you do a deal without signing that letter of intent?
I'm sure you can. It's unusual, but yes, you can say, I've seen people try this. Let's just go straight to agreement.
Interesting.
I think being prepared is a key part of that. If you know that this company is offering you a market clearing bid and it's compelling and you like them and they have a good reputation and they're checking every box for you in terms of what's important to you, terms, valuation, how they're going to treat employees, your role in the future, and it's everything you want, just go fast.
Excellent.
And keeping in mind that you might have to have advisors help you do that just to maintain the speed that you want.
Thank you. Another question is sort of around customer concentration. So what happens if you have a business where your revenues are really largely dependent on one large client? What happens to those transactions? I assume some of those transactions get done, but in your experience, what are you in for if you're a business you really only have one big customer?
Well, they can get done. Obviously, there's going to be a lot of due diligence around that customer and that customer's contract, and you're going to feel, you're going to feel a bit exposed in that regard because that may be a competitor who is going to read your contract and tell you. Eventually, they're going to know your secret sauce with respect to that, and they're going to have to decide whether they want to buy you or just wait for that contract to expire and compete around you. It's pretty vulnerable. So I would take a really hard look at that contract, and I wouldn't be surprised for that customer relationship and try to come to a realistic conclusion of how transferable that relationship is. It's not uncommon to say, we'll buy you we'll put a little bit of cash down and and for the next 3 years, we'll pay you some percentage of whatever you maintain with that client. That's a common way of dealing with that. But it's not sell it and walk away.
No. Interesting. Here's a very interesting case. What happened, have you seen transactions where there's an old company that's run through some really difficult times? So currently revenues are zero. The management, they need to hire a new management team. I mean, the company broke for a period of time, but it has some real good underlying assets, especially IP assets. Can you actually sell a company that is in that turmoil stage and is looking to kind of regroup and restart and has some assets, or is that such a unique circumstance that very rarely will that ever come as a company for sale?
I'm trying to think of my own experience. The closest I've come to that, it was to essentially sell the customer list or the technology to the buyer. So the company, and that's a problem because you have to keep the company open, or you have to get whatever. In that case, it wasn't a particularly good. I remember why they sold. They just wanted to get out of the business because it was a very was a very volatile chemical on the chemical company didn't want to keep inventory of that anymore. But yeah, it can be done. It's not going to be done at a super premium. If it's IP, I would think it would just be some kind of payment on performance, and that's going to be difficult because you're going to need to audit their performance. It wouldn't be, I've certainly seen companies buy IP simply to shut down the competitor and never use the IP. And so the problem with that is, okay, I'll give you $500,000 of cash, and if we sell anything, we will pay you a royalty. Well, then they don't sell anything, and then it's up to you, the former owners of a distressed company, to spend the money to chase around that buyer.
Excellent. Another question, is around. It's kind of trying to ferret out from the buyer side, if you will. I'm guessing the buyers aren't going to share what key elements of the seller that they really truly want and can leverage. But if you're a seller, how can you guess or ferret out what are those value enhancers that really the buyer is looking to you that they can leverage upon sale that you might be able to leverage during those negotiations? I mean, it's kind of like the situation where they're probably not going to disclose to you the jewels they see in your business. So how do you uncover those hidden jewels so you can leverage those during that selling process?
Well, I would tell you that the process is certainly a courtship, and it's important to. I think it's important to maintain what I call transactional goodwill, and as to build a good working relationship with the buyer, and they may share stuff with you to do that. Look, you're going to have to make your best guess. Sometimes it is obvious the reason for that. I sold if anybody's old enough to remember it, I sold a company years ago called Smalls Formal Wear, which was a tuxedo rental business in Philadelphia. Well, it was the third largest tuxedo rental company in the country, and we had been approached by the largest and the second largest, and it was pretty clear what was going to happen. It was pretty clear what the synergies were, and then the largest one bought it for a premium price and clearly became the largest. The number two became a distant second. Buyer one overpaid for it, and then they got bought by David's Bridal, and then David's Bridal got bought by May Company. So our client did well. The buyer ended up getting a bigger multiple, partly just because it was a bigger company. So that was an obvious one. Other times you just have to guess. Is it about the customer? Is it about the geographic location? Is it about the technology ones? The technology ones are the hardest to figure out sometimes.
Okay. Another question, and maybe and for those, Steve, we will get your contact information out. So this person had a question about lawyer fees and what attorneys you've worked with that you recommend. That could be an offline discussion unless you're comfortable talking about it here.
So I'd rather do that offline.
I think that's probably an offline question. But instead of the total fees, can you sort of highlight, to get a good attorney, what's the hourly rate going for now? I mean, how much should people be looking for as opposed to the total nut?
The reason I'm hesitant to that is I don't work for them, but many of them have a program where they will defer a portion of their fee for entrepreneurial companies. They will also defer a portion of their transaction fee until closing. So the largest firms, which you don't need, are, I would say, like $1,000 an hour. Those are the New York white shoe firms. You don't need that. In Philadelphia, I think it's between $500 and $700 an hour for a senior associate and a partner. And some of that can be deferred, but I don't know for sure. I just see the funds flow.
Okay. I think with that, I think that addressed most of the questions. What we'll do is, I think Nicole usually send out some feedback forms. If people want to request, a follow-up session with Steve, we can certainly arrange that through the feedback we get from you on this webinar. So please, if you receive it, fill it out, and if there's follow-up, we'll attend to that. Steve, if any other questions come in, I will capture those, and we can send out an email response to companies as well. So,
And Mark, I do have on my last slide, what you guys have is my make an appointment link.
Okay.
The meetings at HubSpot, et cetera, that can, so if you want to distribute that to people, that they can go on there and just do it directly.
Okay. Nicole, can we put that in our follow-up form so that's easily known to everybody?
Sure, yeah, sure.
Okay. So with that, it was a really interesting discussion today. Steve, thanks for your perspective and insights and sharing your acumen. Thanks to all the attendees. It was a really robust session this morning. Just want you to have continuing good spring, good health, and looking forward to brighter days ahead. So thanks everybody for attending. Steve, thanks for presenting. And with that, we'll conclude.
Thanks, everyone. Bye.
Thank you.